Let's bring in Nancy Davis now, Quadratic Capital CIO, for more on the market volatility, particularly in the interest rate side. It's good to see you. What's your reaction here to what the Fed did and said?
Well, Scott, the 75 basis points was not really a surprise. The Fed's been very aggressive with their forward guidance. It was already priced in. It really wouldn't have mattered if they hiked 100 or 150 basis points. We still have another almost 200 basis points of hikes fully priced in this year. I think the thing that I was very disappointed with the Fed was they didn't really talk about the balance sheet. I was sort of like, that's the elephant in the room. The balance sheet, the caps are set. It's already priced in, and I was expecting more from them. I felt like it was a little bit of a weak hand, a weak hand even saying it felt like the right thing to do to hike 75. I think the Fed is only focused right now on the demand side of the inflation equation. What about the supply side? How are we going to handle that? What about the money supply? What about the fiscal spending? What about the tight labor market? So I was definitely left wanting more, but I think one thing for sure, it's very bullish for fixed income volatility. It's, I think, relying on that negative correlation between stocks and bonds might be something that is a thing of the past.
Few things in what you just said that I want to get at a little bit further, because it I think goes directly to interest rate volatility, where you say it's very bullish. They did raise their rate outlook to get more in line with where the market is, right? I mean, we saw them clearly do that, which seemed to calm down the bond market, which has been screaming lately. Do you think that will have any impact on rate volatility? I mean, if you look at let's say a week to date of the 2-year yield, you can see when the leak happened that the Fed was going to do 75, yields exploded on the 2-year and elsewhere along the curve. But what about the idea? Fed more in line with market, bond market and yields calm down. Yes or no?
Well, Scott, you make an astute point, because volatility works on both sides. It's not just higher yields, it's lower yields. It's technically the movement in prices. And the market has priced in almost 200 basis points more of hikes have been priced in this year. So I think what you saw yesterday was a little bit of a relief that the Fed was kind of easing off absolutely hiking another 75 basis points at the next meeting. But 200 bips are priced in. And so I think vol works on both sides of the equation. It's really what's priced into the moves in the market. And the market has been very complacent, saying, you know, that the Fed hiking rates is going to reduce inflation expectations. And so it's this bizarre environment. All markets work off of two things, right? Fear and greed. And right now the market is very fearful. When you look at equity markets, for instance, but the rates market is incredibly complacent, thinking these Fed policy hikes is going to. The U.S. yield curve in the forward space, which accounts for the hikes later this year, is actually negative. It's fully inverted. That means, you know, I lend you money, I get paid less to give you a longer dated loan. So the rates market is priced for a very disinflationary environment, thinking these Fed hikes are going to stop it. And I think that's really an opportunity for investors to look at ways of capturing future inflation expectations that are priced at very cheap levels, in my opinion.